Hello and welcome to a discussion on how to report transactions on the income statement. After viewing this video, you should be able to describe the two formats of the income statement, the single step and the multi-step, explain the meaning of the lines and subtotals reported on the income statement, and identify and properly report restructuring expenses, discontinued operations, and extraordinary items. The multi-step income statement is used by companies that primarily sell goods. Manufacturing companies, retailers, and distributors generally provide a multi-step income statement so they can give information on the cost of goods sold and gross profit related directly to those goods sold. The single-step income statement is used by service companies that do not sell goods. There is no cost of goods to report, and the statement presents the operating expenses incurred to provide services. One presents cost of goods sold and gross profit, and one does not. Operating expenses through net income is reported in the same manner under both formats. Let's walk through the multi-step income statement and then compare it to the single step. The income statement begins with sales, the value of goods provided to customers. The cost of the goods is subtracted to report gross profit, which is the profit on only selling the goods. This profit must be used to cover the cost of operating the business in order to sell the goods. This gets us to operating income, which is the income earned during the period associated with providing goods to customers. The business does other things that are not directly related to customers, and the results of these things are reported under other revenues and expenses. This gets us to income before taxes, and tax expenses reported to get to income from continuing operations. This is the income that is expected to continue in future periods. Items that are not expected to occur in future periods are reported next, and the final net income is reported for the period. The single step is just like the multi-step, with the exception that there is no cost of goods sold and gross profit because the primary business is not selling goods. It is providing services. The amount the company expects to receive for the goods or services provided to customers is sales. Cost of goods sold represents only either the cost paid to buy from a supplier or the cost to make the goods. Gross profit is the sales price less the cost to buy or make the goods. This is the profit earned directly from selling inventory. Operating expenses are directly related to providing to customers and running the primary day-to-day business. Operating expenses are selling and marketing expenses related to acquiring new customers and servicing current customers. General and administrative expenses related to operating the organization. Research and development expenses related to developing new products. And restructuring expenses incurred to reduce future operating cost, along with permanent impairment of long-term assets. Let's take a closer look at restructuring cost. These costs are reported as operating expenses because the company is restructuring operations and revising the operating expenses going forward for the purpose of increasing efficiency and reducing future operating expenses. Common steps taken to reduce future operating costs are consolidation of facilities and product lines, closing unprofitable stores, or laying off employees. The company plans to continue to operate the business and provide the product or service after the restructure occurs. Restructuring expenses are recognized and reported in the period the restructuring or the obligation related to the restructuring occurs. These expenses are usually estimated, and the amount is adjusted when the actual cost is known. Users of financial statements should use the information when projecting future income. The company's intent is the result will reduce operating expenses in future periods. Companies that continuously report restructuring expenses period after period are not accomplishing their goal. There are two subtotals that are given a lot of attention by users of the income statement. Operating income represents earnings from the primary day-to-day business of providing goods or services to customers. The information from sales to operating income is used to project future earnings. Income from continuing operations reports the earnings related to the entire business that is expected to continue in future periods. Investors and creditors use these subtotals to project future earnings. Other revenues and expenses are included in income from continuing operations. They are expected to continue in the future, however, they are not directly related to doing business with customers. Examples of other revenue and expense are interest expense, which is the cost of borrowing money, earnings from letting others use excess cash, rent income from leasing excess space to others, gains or losses on the sale of assets for more or less than the net cost, as well as losses related to unusual events. After other revenues and expenses comes income before tax. Income before tax is used to compute the tax expense for the period. A percentage of income before tax is determined by the Internal Revenue Service. Income tax expense is reported separately because management has very little control over the amount. An IRS rate of 35% and income before tax of $100,000 will result in income tax expense of $35,000. Discontinued operations and extraordinary items are reported after income from continuing operations because they are not expected to occur in future periods. Gains and losses on discontinued operations and extraordinary items are taxable under IRS rules. The gain or loss is reported net of tax because the tax expense line item does not consider these items. Net of tax means the gain is reduced by the additional tax that must be paid, and the loss is reduced by the amount of tax saved from the ability to deduct the loss on the tax return. Extraordinary items are material gains or losses that are both unusual in nature and infrequent in occurrence. The gain or loss is not expected to ever happen again given the company's normal operating environment. Examples of extraordinary items are a flood in a California desert and assets seized by a foreign government. Unexpected events are not always considered extraordinary items. An occurrence must be both unusual and infrequent to be reported as an extraordinary item. Items that are only unusual or infrequent, such as employee strikes, floods, hurricanes, are reported as other revenue or expense and are not considered extraordinary items. Let's look at how an extraordinary gain is reported on the income statement. A company with a tax rate of 35% earned $500,000 before income tax, before an extraordinary gain of $100,000. The extraordinary gain is reported below income from continuing operations. It is reported net of tax since the income tax line was computed without considering this gain. The net amount of $65,000 is computed as the gain multiplied by 1 less the tax rate. The tax expense is computed as the gain multiplied by the tax rate. Now let's look at how a loss would be reported given the same situation. The amounts are the same. The only difference is the loss is subtracted and the gain was added to get to net income. A gain is reduced because extra tax must be paid. A loss is reduced because the loss gives tax savings that offset the loss. A discontinued operation occurs when the company is no longer involved in operating a segment of the business. A segment of the business is a piece of the business where the operations and cash flows can be clearly distinguished from the rest of the entity. A discontinued operation is reported when operations are held for sale or they are being disposed of, and both of the following situations exist. The operations and cash flows of the segment will be eliminated from the ongoing business, and the entity will not have any significant continuing involvement in the operations of this component after disposing of the component. The company must be getting out of a significant portion of their business to report a discontinued operation. Take a moment and review the types of things that generally qualify as discontinued operations. These include an operating segment, a reporting unit, a subsidiary, a group of assets, a geographic region, or a significant product line. A footnote disclosure must be made to provide information on the discontinued operations that includes a description of the segment being discontinued, the types of assets and liabilities associated with the discontinued operations, and the reason for discontinuing and the expected manner of disposition. Earnings from discontinued operation are reported separately for all years. Discontinued operations will no longer be a part of continuing operations. Users of financial statements that attempt to project future earnings should not include discontinued operations. Discontinued operations are either sold by the end of the current year or are held for sale and not operated as part of the business. The gain or loss on sale is generally reported separately from the results of operations during the year. In this example, the segment earned a total of $650 operating before it was sold and an after-tax profit of $500. The gain on the sale of the asset was $260, reported net of tax at $200. FASB also allows another method to be used to report the results of discontinued operations. In this method, the results of operating during the year is combined with the gain or loss on the sale. The total amount of the gain on the sale is reported before the tax expense related to the discontinued operations to give a total net on discontinued operations. This method of reporting is allowed, however, it is not used very often. Discontinued operations are reported when a segment that is held for sale is expected to be sold within a year. Any loss on impairment of the assets held for sale is reported separately. Take a moment to notice the separate lines for operating the business during the current year and for the impairment loss. Both amounts are reported net of tax. The assets and liabilities that are held for sale are reported separately on the balance sheet on one line item called net assets held for sale. They are reported at the lower of their book value or fair market value less the cost to sell. The types of assets and liabilities held for sale are disclosed in the footnotes, and assets held for sale are not depreciated. After viewing this video, you should be able to describe the two formats of the income statement: the single step and the multi-step. Explain the meaning of the lines and subtotals reported on the income statement, and identify and properly report restructuring expenses, discontinued operations, and extraordinary items. Please go to StudyMyAccounting.com and work through practices you learn for examples of how to properly prepare and interpret an income statement. Then work the practice test. Please write out your answers and check your understanding to the answers provided. Thank you for being prepared for class. It is very much appreciated.